Welcome back to the Fire Grind. My name is Daniel, and on this channel, we talk about personal finance with a focus on the stock market. In today's video, I have 4 stocks for you that are available on Wealthsimple Trade for the month of July. If you're interested in signing up for Wealthsimple, you can do so down below in the description. I have a link there that gives you $10 once you make $100 in investments on the platform. Without further ado, let's jump right into it. The first stock we have on the list is Sienna Senior Living. Sienna Senior Living is one of the largest retirement residences and long-term care homes within Canada. Their stock recently was hit from the virus, which plagued many retirement homes. Today, the stock price is sitting around its 52-week low and hasn't seen these levels since 2010. Investors have punished this stock since it was one of the hardest hit long-term care homes by COVID, and they reported more than 290 cases throughout all their facilities. Investors fear that children will become wary of putting their parents into any of Sienna's long-term care facilities in the future. And the reason for this is because Sienna had one of the largest outbreaks compared to other retirement residences, meaning that maybe their cleaning practices and their social distancing practices are not up to par. On top of all this, 2 executives left within the past month, including the CEO, Lois Cormack. Lois Cormack stepped in as CEO in 2013 and turned the company around after it was floundering for a while, and shares appreciated around 72% 2 years later. And the fact that she left during this turmoil was a bit of a red flag for investors, because if she could turn the company around previously, why did she leave now? Now let's take a look at some of the numbers. As of June 2020, occupancy dropped by 5% in the retirement residences and only 0.3% in the long-term care homes. And they still managed to increase their AFFO, or adjusted funds from operation, by 3 cents per share. And this is despite a lower occupancy rate. However, they achieved this through lower interest rates, income tax, and share-based compensation mainly. There was marginal increases from increase in rent. Currently, their dividend yield is around 10%, and they have a 61% payout ratio, which is at historical lows. So my opinion on these numbers is that although their occupancy in their retirement residences dropped by 5%, they still held very strong in their long-term care homes. And the long-term care home sits at around its 97% occupancy rate, which is pretty phenomenal for this time. Now let's take a look at their balance sheet. Their current ratio is around 0.25%, so this is the current assets divided by their current liabilities. But most of their current liabilities is the current portion of their long-term debt. And if we dig a little bit deeper into the financial statements, we can see that the current portion of this long-term debt is due in February 2021. So they roughly have around 6 to 8 months to figure out where this cash is going to come from. And management feels confident about this debt because they can reissue more debt to cover this current debt, as well as possibly issue more shares. And this debt that they issue to cover this current debt will actually be due later on in the future. So they're kind of delaying their problems. But at least this business is still generating revenue and increasing their AFFO. Although there's a lot of negative pressure on this company recently, I believe that long-term care homes and retirement residences still have a great future ahead of them. And this is because baby boomers are entering the stage in life. And we can see that if we look on average how long it takes for people to get into these long-term care homes, it takes roughly around 150 days before someone is accepted into this home. And some residences, the premium ones, actually have a wait time of around 5.5 years. I currently have a small position in this company, and if you want to find this company on Wealthsimple Trade, you can search up SIA as a ticker symbol. And if you're planning on investing in this company, just know that there's some short-term risk based on their debt levels, but there is a long-term tailwind playing in their favor, which is the baby boomers. And if you are currently an investor or going to invest in the next couple of months at these prices, you can be sure that you're going to be collecting a 10% dividend yield. But the fact that investors sold off the stock so heavily, they believe that this juicy dividend yield is not worth it for the risk. But if we look at the payout ratio, it's sitting at around 61% of their AFFO. So in my opinion, I believe the dividend is relatively safe in the short term. The second stock on this list is riocan, and this has actually been requested by some of my viewers. Riocan is one of Canada's largest retail REITs and a staple in many investors' portfolios. The stock was hit hard because of mandatory retail shutdowns, which happened starting in March. And since then, it has dropped 55% in March and is currently down around 45% from its February highs. Last time we saw share prices that we see today was actually during the 2008 and 2009 financial crisis. During this pandemic though, investors sold off most retail and office space REITs. And this was out of fear that tenants would go bankrupt and rental income would decline heavily. And if we look at some of their numbers in April, it's rightly so that investors sold this off. They received roughly around 55% of their tenants' rents. 28% of that was split over the following 3 months because tenants were not willing to pay right up front. They wanted to defer that rental payment, and 17% of the rent was actually deferred to a later date that's indefinite. So this 17% of rent that's deferred indefinitely, this is where the risk really lies. These are probably the clients that are at potential of going bankrupt. But if we look at their client base, their top 10 clients include companies like Walmart, Canadian Tire, and Loblaws. And these are very strong retailers that still continue to do business during this pandemic. And another thing about riocan is that they focus on major markets like Toronto. And for cities like Toronto and Canada, I foresee them continuing to grow as young people like to move to the city and find jobs there. Now, taking a look at some of their most important numbers. The first thing that really surprised me when I dove into riocan's stock is that their price to book ratio is sitting at around 0.59. And what this means is that if the company were to go bankrupt today and had to sell everything, investors would be able to recoup the current share price as well as some more on top of that. And if we look at their dividend, they currently have a 10% yield. And what this equates to in monthly payouts in cash is $38 million. And if we look at their current liquidity, they have a liquidity of around $1 billion, which means this dividend is likely safe for the next 2 years. The amount of cash they actually pay out on dividends is less than $38 million because shareholders can elect to receive new shares instead of cash. The payout ratio for this dividend is 77% of their funds from operations. So in my opinion, this is relatively safe because riocan is currently collecting around 83% of their current monthly rent. Currently, I do not hold a position in riocan, but I am looking to open up a position in this company because their price to book value ratio is so juicy right now. And that 10% dividend yield is very hard to pass up on. And if we look at how they performed in the 2008-2009 financial crisis, the stock basically doubled in the next couple of years afterwards. So I think we could see major price appreciation of their shares in the following years. And on top of all this, the 10% dividend yield right now is icing on the cake. The third stock we have on this list is Drone Delivery Canada. Drones were one of the hottest technology toys in the past 5 years, with companies like DJI and GoPro releasing their own version of drones. They also have a commercial use case, such as videography, military, and delivery services. But for delivery services, this currently has not taken off, no pun intended. And this is because of safety concerns that it raises in populated areas. Drone Delivery Canada has taken on a different strategy though, and this has allowed them to begin commercialization in the previous quarter. Drone Delivery Canada's business consists of a software platform as well as their hardware. They write their own software for their command center where drones are monitored, and they have also developed 3 different types of drones with different payload capacities. One of the drones is already certified by Transport Canada and doing deliveries to date, while the other 2 of their larger drones are going through certification right now. The reason why Drone Delivery Canada is able to commercialize their business right now is because they're delivering to rural areas as well as doing in-flight drop-off for emergency responses. In places where they deliver to right now, they actually set up their own takeoff and landing pads. And this go-to-market strategy has allowed them to avoid the safety concerns which people typically have when you're flying in populated areas. In being one of the first companies to commercialize their drone services, Drone Delivery Canada is a leader in the drone space. And if you look at the stock charts, the stock recently popped 70% from its March lows. And this is after announcing 2 commercial contracts, one with DSP Canada and the second one is with Global Medic. And for context, DSP is actually a global brand and they have a market cap of $28 billion. In both these companies that they have contracts with, it's to deliver medical supplies. With Global Medic, they're delivering medical supplies to First Nations reserves. And how Drone Delivery Canada acquired these services is through their partnership with Air Canada. And this partnership with Air Canada is basically Air Canada marketing Drone Delivery Canada's services on the delivery platform. So Drone Delivery Canada does not have to invest too much in marketing and sales. They can rely on Air Canada's platform, which has a large amount of customers on there. And I expect more contracts to roll in the following months. Now turning over to the financials. At face value, they have a very solid balance sheet, with current assets sitting around $13 million, cash levels sitting around $9 million, total liabilities at $2 million, and current liabilities at $1.7 million. This gives them a current ratio of 7.6. Some would say this is a little too high and that management is not deploying the cash efficiently. However, if we look at the operating activities, this costed them $13 million in the previous year. So these current assets that they have will only allow them to fund their operations for another year or so. And with their cash on hand, they're not even able to fund their operating activities for the next year going forward. But if we look at the cash flow and how they were able to fund their activity in the previous year, this was mainly due to an equity raise. And their cash flow was a negative $4.5 million. So meaning that they didn't raise enough cash to cover their operating activities, but they had a decrease in their cash balance. And my prediction for this company going forward is that they'll likely need another equity raise in this coming year in order to continue operating. So if you're planning to become an investor in Drone Delivery Canada, just know that along the way, you're going to see some share dilution. And currently, I have a fairly large position in this company for my Wealthsimple portfolio. And this company is one of my largest spec plays in the portfolio. I think that it's possible that the company could actually 10x in the next 5 to 10 years. However, this is not without significant risk. And the risk really lies in their share price. If their share price drops in the coming future when they're raising equity, this could present a lot of risk because there's going to be some major share dilution. However, if the business is going to continue grabbing contracts out there, I only foresee their share price going up to maybe $1 or $2, and this will make their share dilution a lot less when they're raising capital in the future. And I think just the whole drone space in general, I'm very bullish on it because drones make delivery a lot faster and they're a lot cheaper because there is no human needed to drive a package from A to B. And the fact that drones do not need to obey traffic laws, they can just fly from point A to B straight. This makes it a lot more efficient for delivery. The last stock on this list we have is facedrive. Facedrive is a rideshare platform that focuses on delivering services on a carbon neutral basis. The way they're offsetting their ride emissions is through tree planting initiatives and other things. The stock has been on a tear, increasing by 626% since the reverse merger happened in September 2019. The company is riding the social trend of going green, and they are the only ride-sharing platform that has marketed itself as a carbon neutral company. In 2019, they boasted that they planted 3,500 trees as part of becoming carbon neutral. So why is this important? It's important because with younger generations like Millennial and Gen Z hopping onto the bandwagon of going green, they're boycotting services that are not environmentally friendly for the planet and supporting those companies that are green. And they have this mentality because social media has really been pushing for going green through a lot of celebrities as well as company advertisements. And on top of this, education is also pushing for this green mentality. And for facedrive, this has resonated with their users as they saw the user growth grow by 30% over 5 months, and the drivers who signed up for the platform grew by 25% over the same 5 months. What's more impressive is the number of rides that are taken per month has actually grown by 143% over these 5 months. And for drivers, facedrive has reported being one of the highest paying ride-sharing platforms out there. And those drivers who actually drive electric cars and hybrid cars are rewarded the most. On the facedrive platform, riders can actually see their environmental impact when they take a ride. So this sort of gamifies the whole ride-sharing platform for people to try to make their carbon footprint as low as possible. In other news, the company also acquired a food delivery startup called Foodora, and this allowed them to expand the revenue stream from ride-sharing into also the food delivery business. The company has also been doing some other acquisitions of smaller players and getting into different revenue streams so that they can diversify their income. If we take a look at some of their financial highlights, they currently are being funded by investor money. They raised $9 million through the issuing of shares, and this funded their $5 million operating expenses in the previous year. They used around $4 million in operating activities and $1 million in investing activities. The sales and marketing and operations support makes up $3 million of their operating expenses, while their listing expenses came up to $2.3 million. So these are the major expenses that we saw in the previous year, and the listing expenses came about due to a reverse takeover which took place in September 2019. The transaction of $2.3 million consisted mainly of issuing shares of the company to the special purpose acquisition company, which they did the reverse merger with. So the company currently is not profitable and probably won't be for a very long time. So this is going to be a spec play if I do invest in this company. I think that the fact that they're hopping on these social trends is going to help their business grow. However, downloading the app and looking at the app, it looks very unrefined and almost childish. So I'm a little bit skeptical about the company, and the fact that the shares have appreciated so much since they became public on the stock exchange makes me a little bit wary about investing in the stock. However, I will be keeping this on the radar and seeing how the company grows over the near future and maybe buying in if we see some sort of drop in the stock price in the month of July. So those are the 4 stocks that I have for you guys today. If you enjoyed this video, smash that thumbs up, leave any comments that you have down below, click the subscribe and the notification bell for future videos going forward. Keep up the grind and have a great day.